And joining me now to talk more about the action in the equity markets is Stash Graham, Managing Director for Graham Capital Wealth Markets. Stash, thank you so much for joining in at the open here. How do stocks look to you?
Like you said, Kristen, good morning. Fairly muted. Certainly, I have not run any marathons recently. It seems like the first month of the year was a big marathon for stocks in general, really all asset classes. But let's see what February brings.
So in terms of what's on your radar in February, we will still have some of these magnificent seven stocks set to report earnings. A big non-farm payroll report on Friday. That, of course, is for the month of January. Stash, what could be the driving factors this month?
Well, as you mentioned, the market right now from a macro perspective is trying to figure out what the next move for the Federal Reserve is. Right now, the market is expecting 40 basis points of cuts, so 1 to 2 cuts for this year. We recently had some softer inflation data. We saw core PCE come in a little bit softer than expected. Real income hasn't really grown the last couple of months. But conversely, you've seen several inflation LEIs, leading economic indicators, that had started to perk up over the last quarter. So right now, I think a lot of people are keying in on how healthy is the labor market, because in fairness to us, I would consider fading most of the jobs data that you get. The way that they're calculated, there's not a nefarious reason. We've seen multiple revisions over the last couple of years, and some be very material. It's really just the way the data is collected. The survey participation rate is very, very low. It's just hard to get an accurate prediction of really how healthy the jobs market at this current point in time. So I think over time, as you get revisions, Kristen, I think you get a better picture. We know hiring, for example, is still at multi-year lows. Businesses are really trying to figure out headcount.
So what do you recommend to your clients, Stash, in terms of how they navigate this environment from an investment perspective?
Right, Kristen. I think there are certain sectors that really do stick out from a value perspective. We've been bullish on banking the last couple of quarters. Certainly that's easy to say now because banking has been one of the best performing sectors the last couple of quarters. But we still think we are in the early to mid innings on a broader rally within the banks. Right now, what you've seen in terms of the yield curve is steepened. Federal Reserve has cut interest rates by 100 basis points. We've seen the yield curve on the long end go higher. That helps bank profitability. Banks at their core still borrow on the short end and lend and invest on the long end. Then secondarily, and I know this has certainly been talked, so you can make an argument, Kristen, this has been priced in. I think we're still waiting to see it, but we have a new administration. We have new leadership and a new ideology. So if we do get a degree of deregulation within banking, there are several catalysts that can help move the banking sector higher. One, capital levels. There's a lot of excess capital at banks. Say capital levels come down. Well, now banks have additional capital that they could return to shareholders, one in the form of stock buybacks or an increase in cash dividends. And then second, mergers and acquisitions. We've seen M&A be really quiet the last year or two. I think, again, that goes back to the prior administration. You figure with this new administration, you'll see an uptick in M&A, and that certainly helps your community banks, your smaller and larger regional banks, that we think is still a part of a larger multi-decade transition of where larger banks in the need of deposits and customers will acquire their smaller banks.
Now, when it comes to tariff, Stash, how are you navigating that, knowing that we have seen reactions in the equity market amid trade policy changes these past few days?
Right, Kristen. And for us, the energy sector, which has been one of our largest sectors, there will be a degree of impact within energy. You've seen what China has responded to, taxing or tariffing liquefied natural gas from the United States. So that is something we're monitoring. I would say right now, with the proposed tariffs on Mexico and Canada, 10%, we don't necessarily believe that 10% is going to move the flows of energy commodities or energy products. Say, like, use example, we'll just use a Canadian oil company. We don't believe 10% is going to really move or incentivize that Canadian energy company to, say, export their goods, because you think about the logistics of that Canadian oil company. They're going to have to ship it on the Trans Mountain pipeline. They'll have to store it. Then they'll have to wait for a tanker to be able to export it. That takes time. That takes additional logistical expenses versus saying, hey, look, maybe I'll take 5 to 10% less. Remember the tariff, the American refiner will have to pay for it, but they have a stronger dollar, so they'll probably be willing to eat some of that tariff. But still, for the Canadian energy company, it's still financially efficient or prudent of them to be able to take the lesser price and move it to the American refiner as they have been for the prior decades.
Stash Graham, Managing Director for Graham Capital Wealth Markets. Stash, thank you so much for joining.
Thanks, Kristen.